So this is the part of the presentation where we do some prognostications, and I always like to joke that we don't know. Nobody knows what they're talking about, and all of the economists and talking heads, if they really knew, they'd be gazillionaires and they'd be on their yachts somewhere, but they're not. So take everything we say with a grain of salt. But with that, we do want to share at least some of the stats that we look at, and hopefully they'll provide some insights to you. So this is what we told you last year. We divided it between the short term, the medium term, and the long term. There's lots on it, but basically what we were saying is that in the short term, we thought rates would trade in a range and they would no longer be ultra low. And obviously you saw rates did start going up. We questioned whether home prices would peak. Clearly they didn't. And we said that vaccines are here, which should be good for return to economic growth. And then in the medium, we said we were worried about whether interest rates go up. Could there perhaps be deflation? Continuing to believe in the story of strong immigration and a muddle through economy, and that you have to watch out for any potential black swan events. And then long term, we said we're still very bullish on real estate. So that's what we said last year this time. Now let's look at a few things. So this is the most important slide that I'm going to present. Basically what it measures is the change in prices. And you can see what we thought was a bubble back in 2016, 2017, and came down in 2018, where we believe in mean reversion, which basically means that prices over time need to go up at the average rate. And if they go up significantly higher than the average rate, then eventually they're going to come back down to average. And they can do that either by going down a lot or by doing what they did in 2018, which was come down a bit and then move sideways for a period of time. In 2017, you had policymakers induced the decline with the B20 rules, which were the stress tests, and foreign home buyers taxes. And that seemed to work until COVID and massive printing of money. And then you can see what's happened now. The price increases have been, breathtaking. Really, it's not, real estate prices should not go up the way they are going up, and it is a cause for caution, and it is instructing how we manage risk in the portfolio. Next slide. This slide just shows you that it's not only happening in Toronto, it's happening in Hamilton and Guelph and Barrie and Kitchener-Waterloo and Collingwood and Peterborough and all markets. And so we'll take a look at why we think that's happening. This is just to remind you that we like to break things down between, economics 101, supply and demand. And we look at drivers on the supply side and on the demand side. And you can see that some of the things which would constrain supply, which are bullish for prices or that would support prices going up, you've got restrictive land use planning policy, you've got outdated zoning bylaws, which constrain housing starts, and you'll see the housing start trend, which is down. You've got resale availability. Right now, you've got very tight inventory, and you've got increasing construction costs. All of these would contribute to contraction of supply, which would push up prices. On the demand driver side, you've got employment's bounced back after COVID. You've got high immigration, and you may or may not have speculation in the market. So let's look at some of those drivers. So this chart shows you, if you look at the red arrow, which covers the gray line, that's housing starts. So even though housing starts, and you read in the press, have been elevated, on a trend basis, they've basically been declining for for 2 decades. They've been doing that at the same time. If you look at the green line, which charts the blue bars, is population growth. So population growth has been strong in the face of declining housing starts. So basically, you're not creating enough supply to keep up with the demand, which is good for prices. Right now, we're in an interesting situation where prices have gone up so much that people are scared to sell their houses because they can't replace them. And so you can see on the far right-hand side, the number of months of inventory right now. I mean, it was tight in 2020. It's even tighter in 2021. The normal months of inventory is 4 to 6 months. And in all markets that we're looking at on this chart, they're less than 1 month of inventory. So supply is extremely tight right now. Next. Sales to new listings is another proxy just to see whether you're in a buyer's market or a seller's market. So this is measuring the number of sales to the number of new listings that are going on the market. And what you can see is between the red and the green bar, that's basically a balanced market. If it's below the green bar, it's a buyer's market. If it's above the red bar, it's a seller's market. And you can see that we're very squarely in seller's market territory right now, which is the blue line, which helps you understand why the orange line is basically going up, which is the price changes per year. Next. Employment, just very quickly, you can see that it was I guess it was the good old V recovery in employment. It dropped during COVID and then came straight back up. And now we're pretty much back to where it was pre-COVID. Next. So this is an interesting slide, and it drives a lot of our thesis about why we're so bullish. There is not enough supply. We believe it's a secular story. Policymakers, to their credit, are at least trying now. The Ford government just commissioned a study to try and come up with ways to help with supply, but that'll be slow, whatever they decide to do. And what you should look at on this chart is this is projections for Ontario's population. And if you look at the dotted lines in the projected corner, the light blue or greeny blue at the bottom, like the low scenario, is still as high or higher than the historical highs for the number of immigrants. So no matter how you look at it, population growth is likely to be as high or higher than it's ever been in the past, which we think will be very positive for long-term demand of real estate in Ontario. Next. So we debated whether we included this slide, but one of the things you have to look at is speculation and how much speculation is driving prices in the markets. And the problem with speculation is it's hard to measure, and you can see many different measures and many different guesses on where it, what percentage of investors are speculators. And so we really like John Pasalis. He's got a very simple and objective measure for this. It's basically just the number of sales, or the percentage of sales that end up being rented within 6 months after purchase. And that's how he is defining speculation, which is nice because it's an objective measure, but it's not necessarily the only measure. So you got to take it with a grain of salt. But what it's showing you is that there was a lot of speculation in 2016 and 2017, and it was knocked out with the B20 rules and the foreign home buyers tax. So his index now, if you look on the right-hand side, just kind of like a zoomed into recent history, it doesn't seem like speculative investors are a significant part of the buyer's market. I'm not sure if that's 100% true or not, but it is an interesting data point nonetheless. Next. This is just to show inflation is definitely real in building construction. And obviously, if your prices go up of your building supplies, it significantly impairs your budgets. Remember, it takes time to build. And so when you start a project and you do a pro forma budget, and then in the face of that, all of a sudden you've got prices going crazy, it becomes very hard to manage risk. So the risk goes up. That would constrain supply because people will become more careful about how much they develop going forward. Okay, so we also have to ask the question, what could force prices to go down? And funny enough, it's the same on the supply and the demand side, which is interest rates and balance sheet strength. So the first thing we'll look at is interest rates. This chart we've been showing for a while at our AGM, which is looking at the weekly household effective rate, which has been exceptionally low, significantly below average, but it is starting to tick up. And so rates have started trending up. You can see the government of Canada, they've bounced off extreme lows, and so they've come up significantly in percentage terms. They've come up, orders of magnitude, and that could and will start eventually taking a bite out of highly levered borrowers. Next. Okay, so all of the talk about inflation, and we've showed you this chart before, but basically inflation is measured by money supply times the velocity of money. And what you've seen is that since 2008, in 2008, during the financial crisis, they started on this grand experiment called quantitative easing, which was the significant expansion of central bank balance sheets. And so that increased the supply of money. But you had that money supply being increased into the face of a rapid decline in the velocity of money. And so you can see that what happened in 2020 when COVID hit, again, the money supply increased, outrageously, but velocity of money cratered. And that's the only reason you don't have Zimbabwe-like inflation. So the question now becomes what happens going forward. Just go back for one sec, sorry. It's likely the Fed, they're talking about starting to constrain their balance sheet. So it is entirely possible the money supply starts to decline. And then the question is what will happen after that? And so that moves us to the next slide, where we decided to have a look at, we've got this theory, and in simple terms, we've been saying, look, supply and demand, economics 101. They printed a ton of money. That money's got to go somewhere. Where is it going? It's going into risk assets, any risk asset, real estate, the stock market, cryptocurrencies, ridiculous NFT pictures of monkeys, all of this stuff. Money is just flying into all of it. And so when you look at the S&P 500, which has been on a tear, it's got a 0.9 correlation, which is very, very high correlation to the Fed's balance sheet. And what you'll find is that most assets have similar correlations. So we looked at housing in Canada, or even in the GTA, sorry, and it's also got a 0.9 correlation to the Fed's balance sheet. And it's interesting because, the Fed is in the US and we're in Toronto, but I think America really does drive global liquidity. And so the question you have to ask yourself is what happens if the Fed starts contracting their balance sheet and reducing liquidity? If the correlation is that high, what will happen to real estate prices? And we believe they would either flatline or go down. And so that's a very real possibility of what could happen going forward. Next. So when we talk about interest rates and leverage, rates, if there's inflation, you increase interest rates. The problem is, how do you increase interest rates into a highly levered society? And so just if you look at how we are on a leverage basis, the gray line is the US, the blue line is Canada. And what you can see is that prior to the financial crisis in 08 and 09, Canada was in good shape and the Americans were highly levered. The Americans had their day of reckoning and they had to delever through the great financial crisis. Canada didn't have our day of reckoning. And so we were kind of just able to tick along and continue leveraging. And so you can see right now, household debt to GDP is extraordinarily high. And one would argue a certain red flag that you'd have to pay attention to in your risk models. Next. Okay, so having said all of that, give you all these facts, maybe we sound super smart, but the truth is nobody knows. And this is a perfect example of nobody knowing. These are last year's predictions of what would happen with real estate prices. CMHC said, anywhere between a 9 and an 18% decline in prices. The Canadian Real Estate Association on the far right, they have to view the world with rose-colored glasses because that's how they get paid. They said 9.1% up. Even they were wrong because the actual was 15.5%. So really, the estimates were all over the map and nobody got it truly right. I guess RBC and CREA would have been the closest, which begs the question for 2022, what are the predictions now? CIBC is the only one saying, hey, we think prices are going to go down. Everybody else is taking, this is recency bias, one of the classic biases in human investing. And so you take your recent experience, you project it out. Yeah, we think things are going to be really good and prices are going to go up. I guess Ben Tal is worried about what's going to happen and he thinks prices are going to go down. We say we have no idea. You can make strong arguments for both, but that's why you have to, what we do at foremost is we try not to take too much risk. We do realize we're leaving some money on the table, but hopefully that sets us up to do reasonably well if, everybody but CIBC is correct. But if CIBC is correct, hopefully we weather the storm well because we've really constrained our loan to value and our risk budget. Next. So again, with the looking forward, and this slide is extremely busy, so I don't think I'm going to go through it too much other than to say in the short term, we feel that uncertainty has increased significantly. And I mean, especially after what's happened today with Ukraine, I think that would be exponentially even more uncertain about what's happening. When it comes to the question on rates, it makes sense that rates will go up because of inflation. However, you have to question the debt trap. So if you increase rates, and people can no longer afford to service the debt because rates have gone up, then you immediately go back to, deflationary type forces. And so I still see it hard for rates to go up as much as people are expecting. But again, we have no idea. If the Fed gets it wrong, you could have a recession. That's a possibility. We kept home prices peaking with a question mark because we think that, the longer they keep going up like this, and obviously eventually we'll be right that home prices have to peak. But certainly the more they go up and the longer they do go up, the higher the probability of a downturn. or something bad happening. So short term, we're just saying more uncertainty. You really got to watch out. Medium term, we're sticking with muddle through. We're saying you got to watch out for the debt trap. We do believe in mean reversion. Will that happen via a downturn or just a flatlining? You know, prices could just flatline for a decade and then the average line will catch up. We don't know, but you got to watch out for that. And again, black swan, some sort of unanticipated event like a war or some sort of, you know, default of Chinese real estate firms that has knock-on effects throughout the world and causes liquidity squeezes. You never know where the black swan comes from, but you got to watch out for that. Long term, we still remain very bullish because we think that the chronic undersupply will continue to be an issue. Population growth, even regardless of whether you have a liberal or a conservative government, you've got to service your debt somehow, which means you need to grow your tax base. In Canada, you can do that by growing productivity and increasing wealth, which increases the tax base. We've always lagged productivity growth relative to the US, so we think Canada is going to have to rely more on population growth than other places. And so, you know, 400,000 is probably low in terms of what you can expect going forward every year with people coming in. And strong unemployment, especially in Toronto, we believe that it will still remain an employment hub and that it continues to be a world-class city. And for those reasons, we're still very bullish long-term, which helps inform why we've started a real estate fund, but it also informs how we lend. Next. So that actually brings us to the end. I want to close with one thought. Foremost has been around for 35 years, and we've learned a lot during that time. And one of the things we've learned is that compounding is an extraordinarily powerful force, but to enjoy the benefits of compounding, you need to be in the game for a long time, and you have to avoid blowing up so you can stay in the game for a long time. We're running our business so that we'll be around for another 35 years. And this means that we have to sacrifice some upside and the associated risk to avoid the blowups. Hopefully you've seen this in the way that we manage the portfolio, and hopefully this approach resonates with you. I think it does because many of you have been invested with us for many, many years, which is something that we don't take for granted. And we're sincerely thankful to have you as part of the Foremost family. And we hope to have you along for the ride for decades to come. With that, I want to thank Ricky, Pavan, and Michaela for preparing this presentation. They really did all of the work and they deserve all of the credit. And I want to thank you all for participating in the call.